Hi, I'm Mike Costa, Chief Investment Officer of Munroe Morrow Wealth Management. It's that time of year when we like to take a moment to kind of look backwards over the past 12 months and try to understand and communicate a little bit about some of the major trends that shaped markets over the year. And also think and communicate a little bit about some of the trends that we expect to shape the year ahead in 2025. So this is going to be a very brief presentation. We're just going to run through some of the highlights. If you have questions or would like a follow-up on any of these, feel free to get in touch with our team, your advisors specifically. So we'll start with 2024. There were a few, well, to begin with, it was a great year for U.S. stocks, to say the least, particularly large cap U.S. stocks. So the S&P 500, that's kind of the benchmark that most people like to refer to, was up 25%, excluding reinvestment of dividends over the year. That's a very good return. And that comes on the back of a very strong 2023. So cumulatively, the S&P 500 over the past 2 years, again reflecting large cap stocks primarily, up over 50% over a 24-month period. So that's been a really strong period and certainly something to celebrate, something to feel good about as an investor. There were a few things that had pretty clear effects to help and that contributed to this upward momentum for stocks over the previous year. So the first is, it's a little bit hard to remember. It seems like a long time ago, but if you think back to the beginning of this year and certainly the beginning of 2023, there were real fears about a recession. There were reasons to believe that we could experience a period of economic weakness. Amounting to some kind of recession. And that just simply didn't materialize. Because it didn't materialize, stocks rose, kind of expressing a bit of relief, you could say. Secondly, earnings growth was relatively strong. We did have a dip at the end of 2023 and at the beginning of 2023, but looking at 2024, what you see is a lot of green here. And expectations for 2025 also pretty good. So, and that's true regardless of sector or which part of the stock market you're looking at. So strong economy, strong earnings, both things that drive equities higher. In addition to that, we've had drops in interest rates. So as you know, the Federal Reserve started cutting interest rates this summer. They've cut several times. You can see the path of interest rates here. And they're expected to deliver at least a couple more this year. When interest rates go down, asset prices tend to rise, whether you're talking about stocks or bonds. Lastly, maybe not leastly, getting past the election itself is a positive. Like him or dislike him, simply having Donald Trump in the White House has seemed to impress the stock market, and that's likely because he's planning or aiming to reduce taxes, both at the individual level and at the corporate level. So those four things, taxes, earnings, economic growth, and interest rates all had a positive effect on the stock market over the prior year. That's by no means an exhaustive list, but I think it's fair to say those are the big things. Of course, not every asset class has done as well as those. International stocks kind of eked out a middling, mid-single digit type of return over the year. Those are all the markets excluding the US. Bonds just barely made it into the green with, using the U.S. aggregate, which is a common index, up just about 1%, and that includes the effect of reinvesting interest. And some esoteric asset classes, for example, like gold, had a really good equity-like return over the year. So kind of a mixed bag. The big headwinds for international stocks and for bonds were really twofold. A strong U.S. dollar made all asset classes overseas look relatively poor. And the fact that interest rates came down was a plus for bonds, but they didn't come down as much as bonds were expecting. And the Federal Reserve has kind of been backpedaling a little bit in terms of how many rate cuts it's anticipating for 2025. And that's just because inflation hasn't fallen quite as far as they would like. So the bond market's just been a little bit, hot and cold over the year, depending on the outlook for those rate cuts. And most recently, we've been expecting fewer rate cuts than we were earlier in the year. So that's kind of what's been happening over 2024. I'll talk a little bit about the year ahead. Obviously, nobody has a crystal ball, including even us. And these are more general statements about some of the headwinds and the tailwinds, the positives and the negatives that we can see for the year ahead. So first, the good stuff. And I don't have any visuals for this, but I'll just talk through it quickly. Uh, the US is anticipated to continue to experience relatively strong economic growth. That's a positive. There are risks, of course. Um, Valuations are probably unsustainably high. So this chart just shows you the PE ratio, or the price to earnings ratio, for the stock market as a whole, partly reflecting that strength that we've seen, that upward momentum in share prices for large companies. The PE multiple for the market as a whole is now well over 20 times, compared to an average of around 16 times. So, probably US stocks are a little bit too expensive right now. That does open up a possibility that we could see some weakness later this year if earnings growth does not continue to impress. Another risk is inflation. It's still above target. If it does not continue to decline towards that 2% target, I think we could see yields on bonds rise a little bit, and that would potentially cause some indigestion for the stock market. But I think the new administration in the U.S. is likely to continue to run deficits. They're likely to do whatever's in their power to kind of goose markets, stock markets in particular. And I think low valuations for assets outside of the U.S., international stocks, bonds of all kinds in all jurisdictions, currencies outside the US, provides a bit of margin of safety for those asset classes. So even though they haven't been performing very well, the fact that they're cheap is a positive in and of itself. So, I think when we sort of sum it all up, it's more of a glass half full scenario for us than anything else. Clearly, there are risks. We keep an eye out on them for you. I think it's important to remember that the last 2 years have been exceptional for U.S. stocks, not normal, not typical. And inevitably, we will see pullbacks for asset classes of any kind, including the U.S. stock market. Even though it's been quite a juggernaut lately, we do have to mentally prepare ourselves for those periodic pullbacks, be ready for them, and if possible, if at all possible, even exploit them to our advantage. So that's why, despite the fact that U.S. stocks have continued to deliver very, very good returns, we do retain that diversification. We hold some of those much maligned international equities. We continue to hold bonds. They're still a good shock absorber for portfolios. And that requires patience, clearly, but when one part of the portfolio is performing well, it can offset some lesser returns in other parts of the portfolio, and that's really why we build portfolios the way that we do. So, look, I'll sign off by saying, it's been a good year. We're hopeful that the year ahead will be similarly good. We take our responsibility to you and your families very, very seriously, and we appreciate the trust that you put in us every day. And I wish you a fulfilling and prosperous 2025. Thank you very much.